Alrighty, so in this video we're going to be backtesting ICT's macros. This would be part 3, probably my final video about macros for a bit of time, but let's get straight into it. So we're going to do a couple of sessions. The first one here is going to be the London session. So I'm going to mark out from 150 all the way until 210. That's the first macro. Now, notice how this macro, it doesn't do that much. It doesn't really run for liquidity, it doesn't do that much. Now there's a key reason for this. There's a bigger picture element. So if one of your macros doesn't perform, there's probably something bigger going on. And what's actually happening here is the power of 3. So in this case, this was a few days ago, we had the accumulation, we had the manipulation to the downside. So essentially, if you're sitting in this range here, if you want to take a short, it's very risky because you know the power of 3 is probably playing out. So the first macro there doesn't have to perform because of the bigger picture narrative going on. And I'd want to be targeting this buy side liquidity that rests above these relative equal highs. So let's go to the next macro. The next macro rests between 250 and 310. So we're going to back test this. So we'll go 310 and we're going to see if there's any entries that go with the idea of having the power of 3. So it's important when you're trading macros, not just to necessarily blindly trade the macros, but to have an idea of what the macro is doing. So in this case here, that there's midnight open price, and I'll mark that with a dotted line. We accumulated at midnight open, we manipulated, we actually rated sell side liquidity and tapped into a 15-minute imbalance. So what I'm going to do, I'm just going to go to replay just so I can show you this. We'll go to the 15-minute time frame. And notice here, right, price rated this sell side liquidity. Now that is Asian liquidity, so we rated Asian sell side, and we tapped into this bullish gap, right? So this is like the premise for wanting to go long. And then what you use the macro for, you use the macro to look for opportunities to go long. So you formulate the bias first. The bias was that we're going to go long because there's a power 3 occurring. Then you wait for the macro to do something important. And if it does something important that fits your bias, then you execute based on that, right? Does that kind of make sense? Because otherwise you're just blindly doing it. Like at this point, we know we've taken our Asian sell side. So going for a short position here, yeah, maybe you could have got a quick scalp, but it's not going to be something that you can hold, and it's not going to go with the overall order flow or the overall narrative. So again, let's wait for this next macro to play out. So if you're in the trade at the moment, or watching the market, here's what I'll be thinking. I'll be thinking, okay, what's going on here? The macro's just started. We've just rated some internal sell side liquidity here. So that's the sell side liquidity rate. And I'm going to just call that R for a rate. Is there an opportunity to go long? Now, when I'm looking to go long, there's a couple ways you can actually enter to go long. And I'm going to mark these out here. The first is, and let me just get this up. The first is going to be after a market structure shift, entering from the return to a fair value gap. The second could be like a rejection block. The third could be like an inversion fair value gap. Those are like the main ways, right? So let's see if one of these things plays out. And I might just make that a little bit larger, just in case it's hard to see. So I'm looking now, are there any inversion fair value gaps or market structure shifts or anything that occurred before the macro? And in my eyes, there is. See this bearish gap here? We disrespect that when this candle closes above, right? So this now becomes an inversion fair value gap. Now, if you wanted to take this entry, what are the confluences to take this entry, right? What are the confluences? Well, we actually had some SMT here that occurred with ES. And all I mean by that was ES, which is a correlated pair, ES was making lower lows, whereas the NASDAQ made higher lows. That suggests that the NASDAQ is the stronger pair, alongside the fact that we've taken our internal sell side liquidity, and also the fact that we're now seeing a macro. Again, time is really important. So the macro ties everything together, but you've got to have the basis of why you could go long as well, right? Plus, if you have a look here, there's highs that have been engineered as buy side liquidity targets. And you know that I love highs and lows that sit within an imbalance, because the market targets two things: imbalances in the form of fair value gaps, or swing highs and swing lows. So this high here is a really good target, even if you don't hold it to the top, right? So essentially at this point, the time of this candle, right, is 252. We come back down, right? If you entered, say, a long position from here, your stop would have to go below this green candle. Now, why below this green candle? Why not below here or here? Well, this green candle actually rated liquidity, so it should be protected. If this green candle didn't rate liquidity, maybe you have to have a bit of a wider stop to account for that. But in this case, that should be sufficient. And let's assume you're aiming for like a 1 to 2 risk to reward, right? And let's just play this out to see what happens with price. Now, there's two things that could happen here. Now, obviously you get tagged for the 1 to 2, but there's two things that could happen here. Number one, if we just keep playing this out, have a look what happens with price. We actually come back down one more time to tap into that inversion. So the first scenario is that you get a very good entry from this inversion and you hit your 1 to 2 and you're done. The second scenario is that you take some partials and maybe you get stopped out at break even. Right, that's the second scenario. So we'll talk about both scenarios and how you could execute on both, right? Now, keep in mind, even once we've created this swing high here, we've still got the target, which is the original accumulation for the power of 3. That still exists. All I see this as is generating more buy-side liquidity. That's all we're doing. So even if you were stopped out here, right, you could then enter off this inversion fair value gap. So that's another inversion fair value gap right there. So see how like you got to let the runners run or the winners run, and you got to cut the losers short. So if you didn't get a 1 to 2, or you didn't take out all your money here, and you got stopped at break even, if the bias is still there and the overall trade idea is still there, you're going to have confidence to stay in that trade or to be able to execute again. Now, that comes with experience. So if you want to just taper it at this point, you taper it at this point. But maybe you went for another long position because we closed above here. Maybe you go for another long position roughly here. Stop loss below that candle. What are you aiming for? A 1 to 2. Now let's see what happens with price. Eventually, price just pushes up, right? We eventually move to the upside. We take out that take profit level, and we'll talk about the next macro delivering in just a second. So it just goes to show, guys, like if you have a look here, right, you've got a little market structure shift here, right? That's your market structure shift. And you can enter off different PD arrays. You know, you're not always going to get inversions. You're not always going to get busies or civvies. Here is a bullish fair value gap by the way too. I'm going to mark that out. So I'm just going to get the rectangle. And price returns to that twice, right? So in this case, you could have gone long somewhere here or somewhere here, even stop below the consequent encroachment of that wick. And you might be like, why the halfway point of that wick? Well, this long wick here, if you have a look, it actually took out this low, right? This down close candle, but it respected the halfway point of this candle. So it should, if you're going to continue up, the halfway point of this long wick, you treat it like a fair value gap. So it should be respected. So this is a bit more advanced, but let's assume you entered for a long position right here. You could put your stop below consequent encroachment of that wick instead of having to put your stop loss all the way down here. Because then, yeah, eventually you get the 1 to 2, but you can reach your 1 to 2 a bit quicker. And that's with the idea that we shouldn't have to disrespect this inversion and disrespect this wick, right? So I use wicks as fair value gaps, and that's an example of how you can kind of use that as like almost like a rejection block, but in this case you're using it like a fair value gap. So notice here, guys, with this macro, this first macro, all we did, right, was raid this internal sell side or buy side, sorry, return to this gap and then move down. The second macro, we had an opportunity to go long. If we didn't like that opportunity, then we could have entered again somewhere here outside of a macro, right? So it just depends. But if you're trading solely macros, there's always going to be opportunities once in a while for you to enter during that macro, which gives you high probability setups, right? So then let's draw the next macro, which is from 350 right here, I believe. 350 to 410, and then let's play the price out to see what the price does. And this is how you backtest. Right? This is how you backtest. So having a look at price action here during this macro, let's have a bit of a look. We pause that. This macro here, if you have a bit of a look, guys, I'm just going to draw this out. There's this bullish gap right there. Now, the question for you guys is, do the bodies respect that bullish gap? Like, are we aggressively closing below? No, we're not. All we're doing is we're tapping onto this candle up close or down close candle, sorry. That there's your order block, that down close candle. So notice how the price comes back down during that macro, tricks people into going short, raids this internal sell side liquidity, right? And after doing so, taps and respects that order block and then bounces off from that. So how you could have used this macro is, even if you didn't enter from here, then you wait for a displacement candle up. Now, technically, you see this candle here, this technically is a market structure shift. The reason why, let me just zoom in and show you guys. The reason why is because this candle actually forms a swing high. That candle's high is higher than this candle's high, and this candle's high. So technically, that there above this candle's high is a market structure shift. And then where can you enter from after a market structure shift? The return to a fair value gap. Now, this fair value gap, if you have a look, say the gap is, you got a volume imbalance there. Let's say this is your fair value gap right here. You can enter maybe at the halfway point or just straight away off this level here to go long, right? Just past that volume imbalance. Where could you put your stop loss? Below this candle. Why below that candle? Because that candle actually took out this internal sell side, so it should be protected. What do you target? Well, up to you what you target, but if you wanted a 1 to 2, you get that. Or you could take off some partials at the top of this accumulation, right? So this is how you can use macros. Some macros are going to give you entries. Some macros are going to show you something important, and you can execute just after the macro. So those are the ways that I use macros, and this is just some examples from the London session. So what I'm going to do, I'm going to exit this bar replay. I hope that kind of makes sense. I know some people trade the AM session as well and the PM session, so we may as well go through that as well. Now, in a previous video, I've talked about this. I'm going to spend very minimal time on this example, just because I made a video recently that's already probably uploaded. And this is about a unicorn setup during this macro. So again, 10 minutes before and 10 minutes after every single hour. This is the PM session. This is this morning. Called out to the Discord. This one here, beautiful trade. So in this macro, what happens? You get a market structure shift. You've got this candle, which is your breaker block. That lines up with a bearish fair value gap and also an order block. So you've got 3 PD arrays supporting price. You have an opportunity to go short right from here, stop loss above that candle's high, targeting this sell side liquidity to start, or any sell side liquidity points you wanted to. If you didn't like that entry, you could have entered right here. And if you wanted to be really risk managed, you could have put your stop above that high. Do you get a 1 to 2 risk reward? Yes. If you wanted to really tighten your risk, you could put it like that, right? So this is an example from today's PM session, and what we might do now, we just might work back through the AM sessions, for example, right? We might work back through the AM sessions. So there's a macro from 950, I believe, to 1010. So 950 all the way to 1010. Now, having a look at price action here, again, you've got to have a narrative. So if you were trading the AM session, look at all this. That there is what I call trendline liquidity. So trendline liquidity is essentially low resistance liquidity. And you know it's low resistance once the moves happen, because look how abruptly the market moves down. So essentially, where's the market open? About 9:30, right? 9:30, we get an abrupt move down and then an abrupt move down again. That move aims to take out this trendline liquidity, right? We take out that trendline liquidity. Now, we don't have to take out all of it. We've had some people ask, do you have to take out all the trendline liquidity? No. We take out that trendline liquidity. And I'm assuming down here, let me just have a look back on replay. I'm assuming there's some kind of imbalance here, potentially, that we could see, right? So notice that we take out this liquidity point and we tap into this 15-minute imbalance. Beautiful, right? So if we go back to the 1 minute time frame now, we've taken out liquidity, that being a low generated during London session. So we've rated London liquidity. We've tapped into a 15-minute fair value gap. Now we're seeing how we can use the macro to our benefit. Now here's the third example of how you can use the macro. So if you take your notes, there's 3 ways you can use a macro. Number 1 is you enter during the macro, right? If it gives you an opportunity. Number 2 is you wait for the macro and enter after. So for example, if the macro raises liquidity or does something important, you can then enter after the macro, targeting other points of liquidity. or you can actually enter just before the macro, hoping or anticipating, right, that the macro will deliver. So there's 3 ways that I like to use macros. These are the 3 ways, right? Enter during the macro, wait for the macro to play out and enter after, because sometimes the macro raids liquidity and you might be looking for the shift and return to the fair value gap. Or enter just before and then anticipate that because the macro is a key window of time that it's going to deliver price. And this is how you'd kind of use this macro in this case, 950 to 1010. Now, we've rated liquidity. Where's our market structure shift? Right here. Beautiful. Now that is a market structure shift right there. Where's your inversion fair value gap? Right here. See this down close candle? Between this down close candle's low and this one's high, there's a bearish gap that gets blown through to the upside. This now becomes an inversion fair value gap, which I'm going to mark out. Are there any bullish fair value gaps here? Yes, there's one right here. Does price tap back into the bullish fair value gap? Yes, it does. So you got 2 opportunities to enter here. Number 1, you enter as soon as the candle closes above the inversion. You put your stop loss below that low or below the inversion fair value gap candle, targeting what you have to, right? Number 2, you wait for the shift and you enter from this bullish gap, putting your stop below this low or below the inversion fair value gap, because the PD array should support price, right? So it just goes to show you got multiple opportunities to enter. Now, where's your target? Where's the easiest liquidity to target? The easiest liquidity to target are all these highs here. The reason for that there's trendline liquidity. It's low resistance liquidity. So let's assume you're in a long position from this bullish gap. You put your stop below that low and you want it to take partials. There you go, right? It's almost a 1 to 2. You could obviously hold for a 1 to 2, but when you're beginning, maybe you take more partials, or maybe you just want to take partials because of the trade you're in. So that's kind of how I see it playing out. This is one of those trades where we know we're bullish on a larger time frame. We know we've taken that important liquidity, we've tapped into a higher time frame PD array, and now we're entering just before the macro, anticipating that the macro will deliver. So you could have entered here from this return or from the macro. So I guess in this case we cover point number 3 and point number 1, right? So this macro delivers in price. Now, once targets have been met, and this is like the extreme target here, and I'm pretty sure this is like all-time highs. So once targets have been met, you can't always expect the next macro to deliver, especially when we're at all-time highs. So at this point, it's just price discovery mode, right? So I hope that kind of makes sense. That's how you can use the macros to execute trades. And again, we can have a look here, right? There is a macro from, this is the London session again. So let me just mark this out. There's a macro from 350 all the way to say 410, and notice like during this macro there's this bearish fair value gap here, and you may have gone short from here, right here in the macro, stop loss above that high or above this candle, this swing high, targeting what you had to. And notice the macro then gives you an entry, but it also runs for liquidity, and the liquidity point is this swing low. Where does that swing low sit? That swing low sits in a fair value gap, which makes it a good liquidity target. So it's one of those things where not every macro is going to do this, but when the macro lines up for you guys, take advantage of it. Take advantage of it. So again, we could use the same principle here. Once the macro is delivered to the sell side target, then we wait for an inversion fair value gap to be created and we enter from a bullish gap to take it higher. So there's different ways that you can use macros, and you can do this in any session. It doesn't matter if it's the PM session, doesn't matter if it's Forex, doesn't matter if it's the London session, right? Here's another example from the PM session, which I took this trade. This is a beautiful one. We had SMT created, right, between the NASDAQ and ES. There was a macro here. Let me go through it from 150 all the way until 210. Let me just move that over. Where was my entry during that macro? So I'm just going to draw this rectangle out during this macro, and that there is a SIBI. Now you might be like, well, why did I enter that trade? Like, what are the confluences? So the first tier is the SMT. So this is making lower highs, whereas ES is making higher highs. That suggests that the NASDAQ is weaker. It doesn't want to go up as much. Plus, we had already respected this bearish fair value gap. So you could have entered here as well before the macro, anticipating that the macro will deliver. That's an example there. And we'd also had a market structure shift here with some displacement, right? So we've had some market structure shifts there. Plus we had an internal rate of liquidity right here. Some people call that inducement. I just call that like an internal rate. So we'd rated internal liquidity. Let me fix this. So we rated internal liquidity. We had SMT, which held. We had a market structure shift to the downside. We returned to a bearish fair value gap already. We sold off from there. But when we sold off, we left the key time-based liquidity points that I was aiming for. And the main one was this one, which is a lunchtime low. Lunchtime lows being from 12 till 1. So that was the sell side liquidity target. So we came super close to this one when we came down. Entry came from halfway in this gap, right? Stop loss above this candle's high, targeting what you need to, sell side liquidity point, and this sell side liquidity point here, right? So you could have taken partials, that's completely fine. And that's exactly what I did, partials and then more partials, right? So use macros to your advantage, have an idea of where the market wants to go, formulate an ideal, formulate a bias. Now, people have been asking me as well, if you made it this far, we'll do a bit of a bonus piece of information. People have been asking me about how I find a bias. How do I get my daily bias? How do I get my bias for the session? It's quite simple. I don't like to marry a bias too much, right? If I'm in any session, and I'm going to write this down, I might just separate it, right? If I'm in London session, and I'll make this quick, short and sweet because I want to talk about more of this in the masterclass, but if I'm in London session, if I'm in PM session, or whatever session it is, I'm looking for time-based liquidity. I'm looking for fair value gaps. I'm looking for macros. I'm looking for trendline liquidity. Simple, right? I'm looking for those 4 things. Now, if time-based liquidity gets taken and then there's a shift and there's a return and I'm in a key time frame in a macro, then I'm great. I'm good to go. If I'm in a macro and we've just rated liquidity and there's trendline liquidity to target, I'm good to go. So my biases come from identifying key points in the market that the market might run to. Time-based liquidity, for example, lunchtime lows, that's time-based liquidity, 12 to 1, right? Identifying time-based liquidity, having a narrative, and that narrative comes from seeing what the market does. Let the market show its hand, let the market do its thing. Once it shows its hand, then you can execute. So this second entry here that I got, that's the first entry you could have got. I got the second one. I already know that the market's starting to respect these bearish PD arrays. That's an extra confluence. Plus, notice all these candles here. This is a bit of extra sauce for you. That's all called immediate rebalancing. See how there's no fair value gaps here? So when I enter a short position here, I expect it to be quick, right? I expect it to be quick. Sometimes when you're in a trade, right, and say there was a big fair value gap here, you might have entered short from this position. It comes back down and then it reverses on you because all it's trying to do is continue the trend. But this is all immediate rebalancing. So I'll go more into this in the masterclass, which will be tomorrow. But essentially, to formulate a bias, look at points of liquidity, look at fair value gaps, and wait for one to be tagged. Wait for a fair value gap to be hit. Wait for liquidity to be hit. Or wait for things to be respected. And you've got 2 options with a bias. You can either trade towards a liquidity point, or you can wait for a liquidity point to be taken out and then trade towards a separate liquidity point. So I'll leave it at that, and we're going to go more into that, in another session, probably in the masterclass. But I hope this kind of illustrates to you guys that macros are one of those things where they're crucial. They're very, very crucial. You know what I mean? Like, they're not always going to play out, but when they do, they do, right? So my advice, like, I'm not a financial advisor, is just to do demo, back test, and forward testing. See this for yourself. When you see it for yourself, you're going to be really surprised with how things work out, right? Just saying, right? Just saying, like, even here's another example. 150 something to 210. What's that macro do? It raises liquidity. You enter just after that macro and go short from this inversion fair value gap and take it lower. Well, let's say you don't like that. Where's the next macro? 250 to 310. What's that macro do? It returns up here into this order block and then starts to sell off, right? So there's all these little things, signatures and price action, that are really, really important here. Again, this is another macro here from 450 to 510. How do you execute off that macro? Inversion fair value gap. Potentially, if there's some SMT here, inversion fair value gap, SMT, and also a market structure shift. So I'm just doing this stuff quickly, but these are things I want you guys to look at, and hopefully you find these videos helpful. So if this is the first video watching from me, welcome to the channel. I've got 2 more videos about macros. I've got about 60 videos talking about ICT concepts, all free. And again, like I said, guys, I've got a Telegram, I've got a Twitter. Follow me in there, I post screenshots of things. And the Discord's always available. Some people have been asking about private mentorships. I've got information about that in my link tree, which I'll post at the end of this video. But until next time, I'll look forward to talking to you guys tomorrow if you can make it for the masterclass. And if not, I'll post more videos in the future. So I'll talk to you guys then.